first of our Applied Blockchain sessions. This is the first event of its type that we've had in this space for, I think it's about 4 years. So it's really exciting to be able to do this, to have people back, and to have such a great crowd as well come to see. We've got an interesting lineup for you this evening. I'm going to present, first of all, our predictions for the year for the space from a technology perspective. Then we're going to have our product manager, or head of product, Andy Campbell, present an update on the work that we're doing on the product side of things. And then we're going to have what I hope will be a very interesting panel. And after that, we'll be serving some food. So hopefully it'll be worth hanging around for as well. So I'll just start very briefly a little bit about the company, about Applied Blockchain. So I started the company, founded it in this space 7 years ago in 2015. And we've been here pretty much ever since. We're a team of around 90 people, mostly technical, mostly developers, based in the UK, and we have an office in Portugal, in Porto, and team members spread around a few other countries, Italy, Croatia, and so on. And some of those people have flown in here today, so you might meet them in the audience. We've delivered, lost count really, but it's probably over 100 projects, and the reviews for our projects are placed through Gartner, so they're independently verified, and we've had consistent 5-star reviews through the system. So we've built up a lot of experience over time. In terms of clients, some of them are in this room. I'm not going to name them, but we have a list here of some of the companies that we worked with, and it ranges from very large enterprises in energy and finance, in a whole range of industries, to crypto startups and various types of companies in between. And the thing that they all have in common is an interest in blockchain and developing blockchain applications. This is a little bit, a few of the events we've had as a team. We do most of our events in Portugal, in Porto, where our office is based. And here, if you get to speak to them, some of the people that we have from the team here today, so Sean, Anna, Andy, and Miguel, who's organising the event. So if you want to speak to someone in the team, look out for them. Okay, so the predictions. The first thing I did for the predictions was obviously go to ChatGPT, and there you go, it's all done, and go home for the evening. Actually, the predictions I think weren't very good that came back, and I know you can try and refine it and ask it for some improvements, but I think the underlying data is still quite old, and I'd like to think that there's a few insights that we can still bring to the table. So we put some of these insights into a report that we published at the beginning of the year, and this is a report, you can see it online, and we go into quite a bit of depth into a few different areas of the technology and why we think things are evolving the way they are. And in this presentation here, I'll just provide a brief summary of some of those developments. And the previous year that we've had, I know we've had a royal weekend, so on that theme, one of the Queen's infamous statements was about an annus horribilis. I think it was 92 at the time, which was not a great year. So we've had an annus horribilis in crypto, in the blockchain world, and there's a few things that blew up. So really the predictions and the view I'm going to present here is the technical perspective, and why we think some things happened, and really the technology underneath and how it should be used to really prevent the type of things that happened here. So the first thing that blew up in a major way was Terra Luna. And the interesting thing about Terra is it was a smart contract, decentralized finance protocol, and the protocol itself was programmed using smart contracts. And the amazing, sort of kind of beautiful thing about the smart contract is anybody can look at the code, can see the code, can inspect it, and you have guarantees that the code that you're looking at is the code that's running, and that's the thing that's looking after your funds. And nothing can happen to your funds really except for what's coded in those contracts. The problem with Terra Luna was really that people didn't really bother checking the code. There wasn't much diligence, there wasn't much publicized about how it works and what the risks are. And I think the hype and everything that was going on in the market at the time just guided people towards the platform. But as I said, there wasn't really enough technical diligence. And that's really something that should happen here, because the blockchain platform itself gives you that option. Right? The whole point is that you can look at the code and you know what's going to happen to your money. We were approached at the peak of the Terra Luna hype, so I think it was about 8 billion or something that had already been invested, and a fund from Asia came to us and was about to put quite a lot of money in, and asked us to write a report about the risks of putting that money in, and also to look at insurance options. And we wrote the report for them, I think it was in January that year, and you can look at the report now, it's quite extensive, and it describes the risks that you could see in the smart contracts, not problems with the code, but just the model itself, the financial model, and which way it could go and what could happen under different circumstances. And the conclusion was that it could go down in a certain way, and we described it there, and 6 months later that was what happened. So the fund didn't put their money in, fortunately, as a result of the report. But it just shows the importance of doing technical due diligence in this space before you put your money in, because that's really what this offers you. The next big explosion was FTX. FTX was an off-chain exchange, but there's certainly a lot of lessons that we can take from that. And so I guess my number one prediction was that we'll have more technical due diligence and it'll become more important. The second is that we'll see more self-custody and or regulated custody. Right? And really what we had with FTX was an off-chain exchange, so the technology of where the trades were taking place was outside of the blockchain, and how things were managed was outside. And when it's outside, you don't have the technology guarantees of the blockchain. So where you don't have those, you need some other framework to give you that safety and security and guarantees. And so that's where you do need regulation. And if when you want to rely on the guarantees of the blockchain itself, that's when you need custody, the asset self-custody, or a trusted custodian that's ideally regulated as well. So we expect to see more, and we're already seeing much more usage of self-custody wallets, hardware wallets like Ledger. Ledger's a customer as well. We've done some work for them on their integration with Ethereum. The second development that we see related to custody and wallets is account abstraction. Account abstraction is a relatively new term, but it basically means extending the wallet that you have into smart contracts. So you can have all sorts of logic that you would normally put into a smart contract be part of your wallet. And what that enables is different types of recovery, like social recovery for your wallet, instead of just relying on a key or some code. You can have more sophisticated ways of recovering the accounts. You can also have things like the equivalent of direct debits, pulling, enabling other applications to pull funds, a bit like a direct debit, rather than just having to push them. So there's lots of different things you can do with account abstraction. And the final one that we've seen is SIM-based wallet, which is more for IoT devices. But this is where the SIM, which has a chip on it, can also hold a private key. And I did an interesting podcast interview with Vodafone, where they've developed a platform exactly for this. So private keys for blockchain in a SIM, and then a platform that allows IoT transactions to be signed by the SIM, and then you have guarantees of where the data's come from the device. And then I guess the third and final, let's say, big event, if you like, that was I guess a negative event of the year was TradeLens closing. And TradeLens was one of the big headline projects in the enterprise blockchain space. It was a project between IBM and Maersk, and it was about digitizing the shipping industry, the processes, and using a blockchain to automate that. The things that I think, I'm going to go through a few more predictions here, which I think really back into that. But the first is more meaningful decentralization and something that's called zero-knowledge roll-ups. Without getting too technical. Decentralization, for us, is kind of the thing that underpins all of the value in the technology. and all of the good stuff that you think you're going to get from the technology. And that's because underneath this, it's all about group security. It's all about having a group, and that group providing those extra security guarantees that you'll get from the blockchain platform. And who that group is, and how they're motivated, and how they're, I guess, how they're set up, that's what dictates how decentralized the platform is, and ultimately how secure it is. Where you have a very small group, or you have one big party that's really running the show, you've got much less of that. And so you've got much less of those security guarantees, and so there's more things that could go wrong, or you're going to get less value out of it. In terms of the way we've seen the blockchain platforms evolving, so we started with layer ones, and the layer ones, I guess the godfather of them all is Ethereum. And Ethereum, very popular, relatively decentralized. I guess a few years in, we started seeing platforms like Algorand and Polygon offer faster, cheaper transactions, still in a relatively decentralized environment, so providing a lot of that security, but much more scalable. So a lot of the traffic went to these other platforms. What we've seen more recently is what are called layer 2s. Layer 2s are an additional layer of technology where you can process transactions, but they roll up to Ethereum. So the decentralization is anchored in Ethereum. So you could run say 10,000 transactions, batch them up, and then they're posted to Ethereum, and so the security is anchored in that decentralization of Ethereum itself. And then there's two primary types that we see. One is what's called optimistic rollups, and that's where this batch of transactions is posted to Ethereum, but there's no real check. So the transactions could be fraudulent, and then there's an incentive scheme for people to cry out and complain if the transactions are fraudulent. So it relies on incentives, and it can take a while until you wait until nobody's shouted out that there's a problem. The second category that we have, which we think is kind of the future of this, is what's called zero-knowledge rollups. And this is where we use advanced cryptography to take those 10,000 transactions, batch them up, and then provide a cryptographic proof about their integrity that can be verified on Ethereum. And so then you've got the layer 1 blockchain actually checking, without seeing the transactions, without processing them all, being able to check that they're all correct. And we see platforms like Polygon's Hermes, Starkware, and ZK Sync as platforms that have been launched in the last few months that provide all of that scalability of a layer 2, but then being anchored in the security and decentralization of Ethereum. The next prediction is we're going to see less on-chain data and more proofs. And I guess the first point I want to make here is, and we see this quite often, I'm looking at Andy, and we sort of look at people that come to us with different ideas for the blockchain. Quite often people talk about putting data on the blockchain, right, and using it as a place to manage data. And in general, that's not a good idea. Right? It's a great place to record ownership, right? To know that you own something, and that's why we have assets on the blockchain. I have an account, and this is mine. I have a smart contract, and these are the rules about how that asset can move around and when it should move. But if I've got data, that's not really the place to put it. And the reason is because you're distributing it. So instead of the data being secured in one place, it's now being spread out all over the place. And the blockchain doesn't manage access to that data. Right? That's not the core part of the blockchain technology. And it's also very inefficient. So you want to process data, if you're going to put it in 10,000 places, that's going to be expensive. So what do we do, or what are we promoting here? There's two technologies that we think are a much better way to deal with data that's related to blockchain and to the assets on the blockchain. One is zero-knowledge proofs, and zero-knowledge proofs allow us to take data outside of blockchain, generate a cryptographic proof about properties of that data, and then verify that on-chain without placing the data itself on the blockchain. And the second type of technology we have is what's called a trusted execution environment. And the example we have is Intel's SGX that we use ourselves for our products. And the trusted execution environment is also called a secure enclave. This is a part of a computer chip where you can store data and you can process it in private where nobody can get to it. and you can produce some output from that, which has a cryptographic guarantee associated with it, which is backed by Intel. So I can do some processing there privately about data, and then prove something, send that to the blockchain, and it can be verified there. And that way you don't reveal your data, again, but you can check it on the blockchain. So these are the technologies that we think are going to become much more prevalent. And the fifth, by the way, I've added another one today, so this was supposed to be 5 predictions, there's 6. Number 5 is that enterprises are going to simplify privacy and decentralization in the way they use blockchain. And what I'm talking about here is, with enterprises, we've kind of had 2 worlds. We've had crypto and enterprise when it comes to blockchain. And they're almost 2 different worlds. Crypto is open. It's focused on assets and applications of assets. And in the enterprise world, we see closed private blockchains, and they're focused on data. They're usually about a business process where data is being shared by a number of participants. The problem with the original enterprise blockchain platforms, the way they were engineered, is that it's assumed that every participant hosts a copy of the blockchain. Right? So if I want to participate in this network, I have to have a node. And the reason I have to have a node is because that's where my data is stored. And then I share it with whoever I wish to share it with. And by having this network, that's how by everybody having a node, that's how you create the network. The problem with that is that if you've got a system where every user or every customer now has to host a node, that's going to be very expensive and a lot of friction for onboarding different parties to your solution. So we think that with the technology I've described to you previously, we're going to move to a model which is much simpler, where we can combine these roll-ups, the ZK roll-ups that I described for scalability, together with the privacy technologies, and then you can basically have a solution which only has one instance, one installation. Right? And that way multiple users could use the same instance of a roll-up. The data is kept private because of the enclave or the zero-knowledge technology, and it can be anchored in a layer 1 like Ethereum, so you get the decentralization. So that way you can use blockchain kind of as a SaaS, if you like. You can have one instance, and you get all of that security, and you get all of the privacy, and your transactions are not going onto the public network, and yet you're leaning onto the public network where everything is verified, and you have the full decentralization. So it's a little bit complicated. I'm happy if anyone sort of wants to talk about this afterwards and wants to get a deeper explanation, we can share. And we've also got the report where we go into a lot of detail about this as well. And the final piece, so we talked about a lot about the blockchain itself. The final piece is more about the edges. And in the edge, we see bridges and oracles. And again, in the last 12, 18 months, we've seen a lot of issues and problems and hacks, especially with bridges. And I found this picture of a paper bridge. And it just made me think about the way bridges were treated and evolved in this space. People really used what was around and what they could find. And as I described earlier with Terra Luna, there wasn't much technical due diligence. And the same was true of bridges. They were a component that sits outside the blockchain, and people weren't really checking if there's any security there. They were just assuming, well, it's okay, it's there, it's attached to the blockchain. But actually these things were very, very insecure. And so what we're seeing now is a kind of next generation of bridges which are built with much more secure technology. We've got a bridge that we've been working on together with Algorand to integrate Algorand with Ethereum, and we use the Intel Trusted Execution Environment technology. Andy's going to speak to that in a minute. So we're going to see more of these types of bridges. The second type that we have is what we call a trustless bridge, where there's almost nothing in between the blockchains. The blockchains are set up in a way that they can more or less verify each other. And with Algorand in particular, and I think Eric's going to speak to this, later Algorand has a feature which allows another blockchain to fully verify it. It's called state proofs, and we use this in London Bridge. And finally, oracles. So oracles is when we have data outside the blockchain, right, coming from traditional applications and systems. We want to be able to verify it on-chain. So again, as I said before, we don't want to put data on-chain, and for the oracles themselves, we need some cryptographic proof that they're correct, so that the blockchain can trust them. And again, we can use trust execution environments for that, and Andy's going to speak to it. So here's a summary of our predictions. They're very technical, but this is what we think is going to drive the next set of solutions, especially the ones that are kind of more institutional and enterprise linked. And in terms of use cases, we're seeing more and more, we're having more and more conversations about real world assets. And for that, these are the kind of solutions and technology that we need. If you're interested and you want to learn more, so we've obviously got this session today. The follow-up sessions that we've designed are more, we're calling them masterclasses. Right? This is where we want to focus on each of the topics that we see people asking a lot of questions about and wanting to learn more about, and that we've been fortunate to have a lot of experience with. And the first of these is decentralized finance. And we're experimenting with this, so we've set up a lunch and learn session. The first one will be on June 9th, which I think is a Wednesday, 12 o'clock. We're going to make these 1 hour. They're going to be very short, sharp, and intense. And we'll really do a beginner's guide to decentralized finance, show some of the applications, the common applications that are out there, and explain how it works. So if anyone's interested in that, it would be great to have some of you back to take part in that session. And the other subjects that we've seen a lot of interest in, so I mentioned real-world assets, the tokenization of real-world assets, where we're seeing a lot of interest on the enterprise side, and product provenance, so supply chain provenance. Again, it's an area that's been around with blockchain for a long time, but like a lot of things in this space, to be done meaningfully and well, it's evolving and it needs to be looked at carefully. And there's better ways of doing things now as well. So those are the masterclasses. The other thing we've been experimenting with, which has been a lot of fun, and we've had some great feedback about, is the Applied Blockchain podcast. So we started this a few months ago. I've been fortunate to have some great conversations with people, and we're going to keep this going, speaking to people interesting people that we meet and we work with in the space. And finally, we're hiring. So if any of you are in any of these roles, blockchain architect, if you have experience as a solution architect, or if you're a senior JavaScript developer, we're interested, so speak to one of the team. That's it. I'd like to invite Andy.
Thanks, Adi. I'm Andy, head of product at Applied Blockchain. So we're overseeing a couple of pieces of product here. One is silent data, which I'm going to go through now, and another is London Bridge, which Adi already mentioned. I'm going to just show a slide on this at the end, but predominantly I'm going to be focusing here on silent data. So to start with, I thought I'd give a bit of an overview of the blockchain space where we are now. So essentially, the tools that have been developed over the last few years, they've enabled trading in a very efficient way. So we have DeFi protocols that can do atomic swaps, we can do loans, we can do all kinds of trading in a very efficient way. But the trading that it's enabled has only really so far been utilized by crypto assets, so what we call crypto native assets. So these would be ERC20 tokens, things that are native to blockchain. So they don't have any kind of real world relevance. Instead, they're assets originating on the blockchain, a lot of which, or let's say at least some of which we can probably agree have questionable value. Probably everyone has a different opinion on how valuable the assets are in general, but at least some of which have questionable value. We've seen kind of, let's say, real-world assets in terms of dipping toes in the water. So USDC is something that's come up and changed quite a lot in the industry. And we also see like PAX. These are like stable coins that are based around a very liquid asset like gold or USD. And essentially what we have is we have a fund in the back that says, okay, for every $1 there's one token. For every 1 ounce of gold there's one token. And these work on, they have varying levels of transparency, but it's kind of a dipping the toes in the water in terms of real world assets. But if blockchain is going to have value, then the infrastructure is in a place where that's good, but eventually it has to actually interact with the real world, right? Otherwise, we're kind of going to see this industry kind of drift away in terms of relevance. I think at some point it has to start touching, real assets, and essentially it needs to enable that trading. Real world assets can benefit from blockchain because the liquidity is there, right? So essentially we have huge amounts of money there. I mean, especially if you look at how much value is really being delivered, there's a huge amount of money kind of splashing around, but none of that money is being used to trade assets of real value, what we consider like traditional assets, nickel, wheat, futures contracts, derivatives, all of these kind of things. So if blockchains are going to enable real world value, they have to start interacting with the real world. And also, it's worth saying, so if we make a distinction between what's happening today with USDC and Pax for gold, these are assets which can act on public data sets. So it's no problem for USDC to publish their reserves, right? That's fine, that's public information. But when we start talking about invoices, futures contracts, these things aren't public, right? These aren't things that you can just say, oh yeah, here's my invoice, here's all the invoices that I received this month. I mean, no company is going to do that. And in terms of how smart contracts today can act on real world data, essentially they use oracles. So an oracle is a service which will provide data to a blockchain. So it's watching the blockchain every time there's a certain event. The blockchain, it will watch the blockchain and it will go off and it will request from an API and it will come back and it will post that data back to the blockchain. If you don't want to trust that data service, then you would make a request to two of them, and in your smart contract you would reconcile those two things. This is working relatively well for public data. It's not like the cleanest approach, but like let's say it works relatively well, especially as you can validate, like if it's public data, you can actually validate if it's telling the truth, right? Because you go to that DeFi protocol and you see, okay, well, it's using this Oracle service to get pricing, and I can see from the web that is actually the price, and it's consistently posted the price for the last 2 years, so I kind of trust this. But when it's private data, this isn't really enough, right? There's a few problems with doing this for private data. One is you need to pass the Oracle some kind of API key or some kind of security token that it can then go and get the data, right? So that means basically handing over your credentials, handing over your keys to the Oracle. If people start to do this, it creates a bit of a honeypot, what's called like in the security industry a honeypot. So like there's basically a ton of API keys sitting in one place that becomes very lucrative to hack. And also it provides a huge amount of power to that Oracle to just call the API using your API key as they feel. The other problem is there's no real way to validate this, right? So like if an Oracle says, hey, this invoice exists, hey, this person's been through KYC, hey, this person's passes the AML checks, there's no real way to validate that. So essentially, like you're taking that at trust. So as a user of that protocol, you need to decide, hey, I trust this DeFi protocol and I trust this Oracle 100%. That's pretty challenging to do, especially when we're talking about real value changing hands. So this is why we've developed silent data. So silent data uses SGX hardware secure enclaves, which Adi's alluded to. I'm going to assume that no one here is familiar with, probably some people are, but we assume that no one's familiar with SGX hardware secure enclaves. They work similar to the biometric chip on your phone. So your phone has a small chip which is a bit different to the rest of, which is separate to the rest of the phone, and it can be used just to generate keys, right? So you can scan your fingerprint and get a key, and it's separate to the rest of your phone. This means that it's very secure because it's not vulnerable to the rest of the operating system. So hardware secure enclaves will use a very, very similar technology, but they can be used to execute arbitrary code. So you can deploy any application. It's not restricted just to generating keys. So this means that we can write an application which can do things like validate a HTTPS certificate, for example, which is exactly how we're using it here. So we're using it to write applications which can request out to external data, run a set of code to say, okay, what's the response of this data? What are the properties? So, for example, with an AML check, it can call the AML service, it can come back and it can say, okay, this person's AML score was above the threshold that we expected, and then post that result on chain. And the result is signed by the actual chip. And the chip is manufactured by Intel. We can prove that, the chip and this process are validated by Intel. So we can prove that we get the certification from Intel to say, hey, we ran this service and we were able to validate that this is the source and these are the properties of the data without revealing the data. So this allows us to do things in smart contracts that depend on private data. So invoices, AML, KYC, on-chain permissioning. And the difference here, like if it's not clear already, so the difference is we don't see the API keys because they go to this secure chip, right? So if someone's communicating their API keys, their credentials with us, then they're not communicating them with us, they're communicating them with the chip, and it goes end-to-end encrypted to the chip. So we don't get the credentials. If we get hacked, it doesn't leak the credentials. If the only requests that we can make are the ones that developers define with us. So if someone defines, hey, I want to do this AML check as part of my smart contract, they code that job, and that's the only check that we can do. We can't do other kinds of checks. So we don't have free access to the API key. We can only do, like, we're just, as an operator, we can only do what we're defined to do. And we can't manipulate with the process, right? So we have this complete proof of source of where the data came from and proof of properties. So we can prove things about the properties without revealing the underlying data. So that becomes very powerful when we're talking about things like KYC checks, where essentially we don't want to put someone's passport information on chain for sure. We don't even want to see it. We just want to go to OnFido and say, hey, OnFido said this check happened and this person passed. Yeah, in terms of like where we think this has value, so we think this has value in permissions within smart contracts. So some of the stuff Adi was talking about, where on a public blockchain, maybe we want to do permission protocols. So we want to have a DEX, but we want the DEX to work with regulated assets, and we want to make sure that everyone who operates on that DEX passes the permissions. So everyone actually has been through KYC, has been through AML, has, you know, if they're trading a certain amount on the protocol, then we want them to go through a higher scrutiny of checks. All of these kind of things that you would want to do in any kind of regulated exchange. You can implement this with silent data, and it will link back to the source of the information. Yeah, and a bit more about the different use cases. So yeah, on-chain permissioning is one. Proof of reserve is another, but proof of reserve where the reserve isn't public. So proof of asset holding, right? So things like invoices, things like derivatives, other pieces of things that I wouldn't want to make public, but I want to prove that I own. So when we're doing, say, a freight forward contract, or all these different, more complicated types of deal, that's an asset and that can trade on chain. But it's not as simple as me just saying, okay, I'm going to publish all my holdings publicly. Like there are tons and tons of assets where that's not really going to be practical. And another one. This is just 3 examples. I mean, really anything where there's a private data set that's being held by a third party, and you just want to prove the link back to that data set. You want to prove the source of the data set, and you want to prove the properties of the data set. But the other one is deposit tokens. So I mentioned a little already about USDC. USDC is very good for the crypto community, but it's not so good for institutions, right? They're not really ready to settle with a stable coin. I mean, we saw what happened with Silicon Valley Bank, where, you know, USDC, I think they're probably one of the more reputable operators, and they're probably doing things quite well. They're publishing these reports. They're doing things certainly better than some other. In my opinion, that's better than some other providers. But we still saw, you know, their banking provider crashes, and suddenly the token crashes 80 cents. If you're going to do, $1 million trade, and then you're going to hold that stable coin, then suddenly your $1 million you just got for your asset is worth $800,000. So we think that what institutions want to do in terms of like easing into the blockchain world is do things like off-chain payments for on-chain assets. So that's when we're talking about things like deposit tokens, proof of backed payments, proof of off-chain payments, and then do an on-chain settlement. And that's another thing that we can do with this. But really, in terms of like the use cases, we're waiting to be told. I mean, these are things that have been told to us by other parties. So when we're having conversations, we're coming up with these use cases. But really, anything where there's private data involved, you can validate in a smart contract with this platform. Yeah, a bit about us, but Addy's kind of been through it. So yeah, we're about to launch our roadmap. We're not presenting it today, but we're going to present it very soon. So yeah, please join our newsletter and subscribe to that. And we're going to launch our roadmap. If you're a developer or you're building any kind of DeFi protocol, anything in the blockchain space really, please come and speak to us. I'm Andy, head of product, so you can come speak to me. Also, Salvagia is in the back, is the product manager, so you can speak to her as well. But yeah, please subscribe, and we'll keep you updated. We're looking to do initial, like working together with certain use cases very closely to build out some initial developments as well, and support our early adopters very well. And yeah, finally, just very briefly, we have London Bridge is coming very soon, so we're looking to launch at the end of this quarter, which is next month, June, and that's going to be a bridge between Silent Data and Algorand. We're going to be launching on testnet. Yeah, I'm going to get back to that one. That's all from me. Back to you, Addy.
Eric,
Good.
what are your views on all this?
Well, I think this is super interesting. The one point I would make, and I don't think it's just because I'm downtrodden of having worked so long in a bank myself for years, but I think a lot of these systems, people sometimes underestimate how difficult it is to change them, and the whole settlement process is one of those. So I think when people say things like, well, why don't we just atomically settle everything? Like, atomic settlement is great for dealing with counterparty risk, but the idea that we would go to instantaneous settlement from T+2, I think people don't necessarily appreciate that there's actually a lot is happening in those +2s. So for example, you have people who are selling assets that they don't have. And so high frequency traders, they sell an asset, and in 2 days is them scrambling and running around figuring out how to cover the position. So I think it's very important when we talk about realizing the benefits and the efficiencies that blockchain brings, that we work with the system that's there.
Yeah, it's interesting. There's different types of efficiencies, believe it or not, in the system today, with different types of leverage that can happen because of the way things are set up. And you could easily lose that if you just switch to having a handle on all your assets and everything kind of being fully handled that way.
And I think the points about sort of the deposit tokens and things like this, or let's drill down for a second as well on, well, what is Circle? Okay, Circle is some bank accounts and it's some money market funds from BlackRock. Okay, so what's the bank accounts? Well, the bank accounts is a liability of Silicon Valley Bank and wherever else they put the money. So it's a liability, right? Everything inside of the money market funds is a liability of the companies that issue the assets that are sitting inside of the money market fund. So eventually you go down, but it's at the end of the day, it's all liabilities. It's all an IOU. It's a promise to pay. So in the same way, I think that if JP Morgan says, okay, well, here's your record in the ledger that says that I owe you a certain amount of money, it's kind of the same thing. And I think as long as you can digitize that, you put it on the chain, you can start swapping things back and forth, and that's where the efficiencies come from.
What do you think are the next, how are we going to get to this? What are the next things that are going to happen, do you think?
I think it's probably slowly and then quickly. There'll be some big things. I mean, part of it already is the fact that we're in a situation where, despite these catastrophes and blow-ups that you went through at the beginning of the presentation, the JP Morgans of this world and other companies, well, they've they've staffed up. They've got 150 people working, and these people are not sort of idle. There's incredible things and incredible projects that are getting done. And I think as that happens, it's a setting of example as well. So it's other people who are not involved in the space. They get the feeling that maybe they're missing the boat, right? So why don't I get Graham and Addy to come into the office and let's have a conversation about what we can do together. It's all that kind of stuff, but I think having credible people involved in the space is so important.
Yeah. It's interesting, we've seen this because we kind of sit in the middle, and if you like, between crypto and enterprise institution, and having been around for a few years, we've kind of seen the different cycles, and usually the crypto kicks off and goes off at an incredible rate, especially around the innovation itself as well as all the hype. And in the meantime, the enterprise institutions start getting interested, and then by the time they've mobilized, the party's over there, but now they're moving.
Right.
So we see,
things like flash loans, I think, are incredibly innovative, and it's not really something that exists in traditional finance, right? Or the borrow lend protocols, where you're like, okay, well, what would the equivalent of that be? What would that mean? Okay, it would mean that the repo trader sitting in HSBC gets to see the books of Deutsche Bank around the corner, gets to see the books of Credit Suisse, and if any of those clients are a little bit under margin, then anybody can just like swoop in, grab the assets, and repay the financing. Like that's kind of a crazy.
Yeah, I mean our version of that. Sorry, our version of
finance
that.
Then, right? But it's sort of that's the second, the third, fourth iteration of.
Our version would be they don't get to see it, but they get proof of the state of it.
Right.
Right. Or the risk around it.
Right. They can put in some cash and take the assets. Right. Potentially.
Okay, good. I'd like to open this up. Has anyone got any questions in the audience they'd like to ask the panel?
Thank you. Hi, I've worked in cybersecurity for like 10 years, so my question's around the cryptography with the ZK rollups and what role sort of post-quantum cryptography will play, and if any of you are working on anything in this space.
So I'll pass it over as well. I do a very quick one, which is Algorand recently implemented quantum resilience in the chain itself, not for the transactions, but for the history of the chain going forward. I don't pretend that I understand how that works. I do have faith in the sort of MIT cryptography kind of Boston people that Addy talks about. So I think that is obviously super important.
I think the summary of it is that our understanding of the way quantum computers work at the moment is they're very, very efficient at doing some types of mass operations and not at others. And so the ones that they're super efficient at, they can really do quickly. And so if your cryptography is built on those, then it's probably going to be cracked quite quickly. But if you use other primitives that quantum computers at the moment are not very good at, then you're on the safe side of it. But we don't really know how this is going to develop. It's obviously very early quantum computers as well. So we have this term quantum resistant, which is those algorithms that we think are okay for now.
There's like 4 or 5 algorithms that I think people have come up with now that are globally recognized as being.
When we look at zero knowledge, I know that there's different types, and ZK Starks, zero knowledge Starks in particular, was developed by Eli Ben Sasson, one of the founders of Starkware. So that's a technology which is supposedly leans on this type of cryptography that's supposed to be quantum resistant. Boris, I don't know whether.
I wanted to flip over to you because I know that I work for a company that does ZK stuff, but asking me to explain it is a terrible mistake. But I reckon that you've done it in a way that I understood, which is great. Thank you. Maybe I'd just like to expand a little bit on the new finance primitives that were mentioned. It seems like we are able to organically create things that didn't exist before. And because we can do that, then we can create new things that finance doesn't support yet, purely through awareness, regulation, registration process, whatever. So it makes me wonder, right, if we have made all of these wonderful things and in the unregulated arena, they're happening, and it's very exciting. It really is very exciting. And you can see people, essentially doing strange and very, very kind of almost treating finance like Legos, right? An old term, treating finance like Legos and creating new Legos, and it's things that seem like magic from a traditional finance perspective. And we see the old world, which holds most of the capital, not wanting to play. And I'm like, okay, so when do these guys come over to our side? Because I'm trying to work with them, and I would very much like them to kind of. I don't think Graham is in that camp, right? He's, he gets it. But when do we get all the capital holders to come over and say, yay, flash loans, interesting, let's build something around that. Yay, liquid staking, interesting. Right now, liquid staking is the equivalent of the devil in regulator speak, right? But I would very much like to see adoption on that level. Yeah.
I think really quickly as well, I mean, one of the things that fascinates me is there's all of these new Legos, as you put it. The thing that crypto doesn't have, I haven't seen an example, is long-term, a rate structure, right? So if you think in dollars or in pounds or in yen or something like that, it's super clear. You say, what's the cost of, in a risk-free way, borrowing pounds for 15 years, 20 years, 30 years, and then you look at the credit quality of the different things and so on. It's like almost everything in crypto lands is just spot borrowing, right? So if you want to go and borrow, you kind of just put up your asset, you take the other asset, you kind of watch the prices move, and if you get under collateralized, you put it. So it's kind of like 95% of the market is repo lands would be the equivalent, which is interesting because then you think about it. Well, how do you create a term structure at rates? Well, it's by having a trusted counterparty, normally a government, who goes like, I will print if necessary whatever money is necessary to, make the asset, pay my coupons and pay my principal at the end. And I think that's something that's interesting.
Hello, hi. My name is Dr. Shiva from iBank. This is for Joshua Daniel. It's very interesting when you say it's coin that you created in deposit. All this time we were looking at asset-backed token or something tangible or something utility or Bitcoin, something, creative. But when you say you create token on deposit, it's really surprised me. Deposit is a liability on your ledger, and you create a token on your liability. How do we call it? Is it stable coin or what kind of coin it is? And it's really opened up something very interesting, really.
I'm not sure what the question especially is, but I concur. I mean, if I were to add an opinion, I have to say it's my personal opinion, not of the institution, being from a regulated institution. I think that's the key.
The question is, you can create a coin on a asset-backed token. First time I'm hearing a liability-backed token called JPM coin. So what's the future? Is it a stable coin, or is it a utility coin, or is it an asset-backed coin? Because you said it's a deposit coin, that makes me think you're creating liability on liability.
I can clarify. So JPM coin is, forget the word coin, but as I said, it's blockchain deposit accounts. That means they are deposits. So if you have a traditional account or a blockchain deposit account, the deposit in it, they are the same, right? It's still a liability. And to clarify to everyone, I mean, it's generally different types of liabilities, right? So commercial banks generally hold the liabilities of the central bank. So that's some called the M0 money. And when you have a commercial bank account, you're holding the liability of that commercial bank. And other FIs might hold the liabilities of that bank and so forth. So when we hold our personal retail money with a bank, I'm holding liability with that particular institution. So so that means from JPM coin perspective, it's still our liability, and there's nothing new in terms of money. It's the same old money, known form of money. The other type I call the deposit token, which is, it's at the moment more of a vision in the sense that's where we're bullish in the sense, in JPM coin, the money still sits in your blockchain deposit account. So it still allows us to do all the other blockchain benefits of programmable payments and smart contracts and whatnot. However, there is still that account construct. So that means the money still moves between account holders of JPM. They would like to go towards is where if maybe as a next step, move towards what if one of our clients could pass that deposit token to a client of theirs, right? A client one, client two sort of relationship. We're not there yet because there's a lot of other regulatory aspects that needs to move. So, but nevertheless, in that the token form of a deposit, it's still our liability. To your point, we're not tokenizing or anything beyond it. We're sort of very bullish on that deposit staying natively on that, whatever the blockchain or the platform be. So in essence, yes, the two different sort of products. One is within our own JPM clients, the deposit token to stay more natively, more bearer-like, being able to ideally move between smart contracts, be part of flash loans, and other concepts that we could build upon in a sense. And it is, even that wouldn't be a stable coin or any of that. And for me, again, personal opinion, not. But fundamentally, money in that sense, when I hold money in my bank account, that is still the bank's liability, as I said. But if you put money in an e-money institution, as the law says in the UK or Europe, then that institution would bank with another bank, right? And when MiCA kicks in, then stable coins would ideally be under the e-money. And e-money at one point, if an e-money issuer becomes too large, systemically important, then they'll have to get a banking license, right? That's the idea. So I think there'll be a retail sort of use cases, then there'll be a wholesale sort of use cases.
No, actually, I'm really glad that I came here. I just came from Financial Times one event, and I was just telling, how do you stop these regional banks run? So I was saying, if you can bring somebody who give the insurance or the assurance so that you don't need to worry about it, or FDIC could be that one. And if you say like that, this would be a great use case for all the regional banks. That's what I thought, really.
I possibly can't comment on that aspect.
But it leads to another question. I'll come back to you. I'll just ask here. Let's say 5 years time, 10 years time. Let's say this technology reaches critical mass and tokenization of all assets and so on. And we talked about you need something to pay with. Will it be crypto? Will it be these deposit tokens? Will it be stable coins? Will it be central bank digital currency?
Okay, I think back the deposit tokens. I don't really think of them that differently. Then I don't know if does anybody here remember or ever used American Express checks, like the physical?
Yeah.
Hands up, and yeah, okay. Some people, so you go, you pay, you get these checks, you put them in your backpack or whatever it is. You go away to some foreign country and you're carrying these physical things. Okay, what is that physical thing that you're carrying? It's basically a deposit that you've made into Amex Bank. That's what you're carrying. And then you go somewhere, you want to pay for something, well, you sign it and you give it to the person that you're paying, right? And I don't think that's very different than if you did have an open system of deposit tokens where somebody gives cash money to JP Morgan goes, congratulations, you're a customer of Onyx, here's your token, and by the way, we've evolved to the point where you can go out in the wilds and you can use this to pay for things. I think it's the same thing. They walk off, they use the token, they go buy a car, they give the token. To my mind, it works in the same way. So I sort of feel like the central bank, like CDBCs, it's kind of nice, theoretically useful, and so on. I don't personally, and maybe because I don't understand enough or whatever, but I don't feel like there's like an enormous benefit that they have that goes beyond what you would already have if you could have tokenized deposits. And the example that I use is if you go to Hong Kong or you go to Scotland and you look at the piece of paper, well, in Scotland it might say Bank of Scotland on it, right? Or it might say something, or in Hong Kong you might see HSBC on the actual physical note. Well, the physical note is a liability. It's kind of what is it? It's a token. It's a certificate. It's something that recognizes that institution is obligated to give you cash money, and that can circulate around the economy, and people can use it just fine. So I don't see why regulated institutions shouldn't be able to kind of, issue tokens in the same way.
Yeah, no, I think what we're kind of talking about here, and it's kind of relevant from a regulatory and legal point of view, is beneficial ownership. And the way that the regs and the legals are right now in the UK and other places, it's quite hard for the token to actually be the underlying thing. So whether it's the equity or the currency or whatever it is, quite often the token is a representation. So in this case, you're almost holding a JP coin, which is a representation of the underlying. In my Vodafone, it's not the master record. There's basically limited law and regulation around how you need to hold beneficial ownership records. So Archax, as a regulated custodian, we can kind of hold anything, and it's sort of up to us, the records that we have for beneficial ownership, so we can keep them on a bit of paper in Excel, maybe any controls around them, but we can pick a blockchain as well. So it opens up the world to us to say, okay, the beneficiaries of this equity, this currency, this carbon credit, whatever it is much more easy. However, over the next, to your question, what happens over the next 5 years, I think tokenization and the token record starts to be the actual legal title to the assets. So people stop having to rely on intermediaries. They can genuinely hold their own assets in their pocket. So when they're trading on their, neobank, Revolut, eToro, whatever it is, you can actually take delivery of your asset and hold it yourself and eliminate this counterparty risk. And I think the only advantage I see for CBDCs in that is, at the moment, we've seen it with Silicon Valley, Signature, others since, is that if you've got another coin issued by someone else, you're still taking, you mentioned earlier Circle, you're still taking that bank risk, the money market fund risk. Central bank, you'd hope, has a lower risk, which I think is the opportunity there.
Thanks. Late question. Thank you for the panel. I'm Daniel from the Building Blocks. Just a question about this discussion. I think the theme that we're touching on here is this bridge between sort of the trustless world and the trusted world, and the old world and the new world. And we're waiting for the old capital to come over, right, to the new world. But they have all the trust. And yet in the new world we have, we can argue about whether they have trust, but they have the brand of trust, right? I have a question that's far more fundamental about I suppose the user experience of establishing that trust. And it's a general question for the entire panel around, how do you go about, are you working on something that helps the user deal with the fundamental challenge in DLT systems, which is the passkey, the seed phrase that you need to store and recover, and maybe not recover in some cases? Because ultimately that's where the trust is, right? If you're able to KYC someone, and if I lose my bank card, if I lose access to my bank account, I can always go into a bank, and that's how I can recover it. How do we solve that problem for the mass market?
Yeah, I just tell you what we're doing internally. It is a huge problem that when people come to us and talk about tokenizing an asset, it's still Ethereum is the kind of the dominant one, and the reason is it's much easier for people to get a wallet, to have the infrastructure, whereas they need to do a bit more learning everywhere else. But what we're starting to see now, and Adi mentioned it in his speech earlier, is account abstraction. So I think like ERC 4337 has started to come about, and people are starting to say, okay, there's ways of controlling this wallet in a better way. And kind of to Adi's last question, I think what you'll see over the next few years is gradually all of this detail falls into the background, and hopefully people just start using DLT services without having to be an expert on all the technology.
Who stores those keys?
I'd like to answer that as well. I think there's a spectrum, right? And I think even outside blockchain, where do I keep my passwords? Are they all in my head? Do we write them down on a post-it note? And so I don't think this is just about crypto, but I think in blockchain. But I think in the blockchain world, we're already starting to have a spectrum of solutions, right? And it goes from having a private key that you need to write down and store somewhere, to account abstraction enabling social recovery, and we've been experimenting with silent data as well, integrating with Web 2 accounts. So maybe using a combination of your Web 2 accounts to recover your key and so on. And we've seen things like social recovery, where you might have family and friends that help to contribute to proving that it's you and you can recover your keys. None of these solutions are perfect, and I think that's, we might not end up with a perfect solution. It might be that you have a choice, and as an individual you decide how you're taking your risk. Do I want someone else to look after the keys for me, and maybe I need them to be regulated, and that's giving me something? So I think it's okay to have a spectrum, but at the moment we're not mature enough really yet.
Yeah, I think it's fine. I think it's a huge barrier, and the litmus test I would say is like, God forbid, but if any of us gets stripped naked and thrown in a ditch on the way home and wakes up unconscious in the morning and all of our IDs and everything like that are missing, there's going to be ways for us to get our life back. And I think unless that kind of unless that happens, then it's challenged.
I can't end on that note.
I've got a few thoughts, and maybe we're overrunning or we're doing this. So sorry, Ali, but I've got opinion on money and the quality of money, right? So interinstitutional, that was a penultimate question, I believe, right? Interinstitutional settlement will never happen without money, which is not central bank money, right? Or rather, we need central bank money in order for it to happen because institutions don't trust each other's balance sheets enough to be able to do that. So that needs to be on chain, and there are conversations now between Polygon and major jurisdictions to try to create the right set of technological and operational assurances. And it's going to be a long journey. It's not going to happen tomorrow. But if we want to track that capital especially onto public networks, which is what many of us are working towards, that's one of the things that we need to have. So central banks need to play, right? Ultimately. What we can do right now, and what we haven't mentioned today, I feel like we focused a lot on TradFi finance, financial use cases, but we can do supply chain, and we can do that with commercial bank money, and the quality of the likes of USDC is good enough for settlement in between large corporations. So we are able to tokenize the value chain, and we are able to have meaningful interaction in between very large corporations who exchange goods and services for commercial bank money because they're already doing that. And we have the tools, we have the know-how, we have lack of regulation, we just have the lack of will and awareness for now. And I think this is the job for all of us. Thank you.
Thank you very much, everyone.